All right, good morning. Today is October 19th, 2022, and I'm back with another Wednesday edition of the live show. And it has been a wild market, and we're in a really crazy market environment right now. So I'll do a quick show and talk about some different things. And we don't have any open trades, and that's probably a good thing because been pretty rough market conditions lately, and the volatility. Wow, the day-to-day volatility right now is off the charts, man. I think it might have been last week or Monday that I did the I did the calculation. Like you can take the 14-day ATR and divide it by the current price of the S&P, and it was like somewhere around 2.5%. And so, like over the last 14 days, the S&P has been moving on average 2.5%. Up and down. And so it's been extremely crazy. And you know, I think it was well, we'll look at the chart here in a minute, but just in the past few days, we had that big gap down and huge rally and all that type of thing, and um, it's like everyone's on an emotional roller coaster, right? Because the market one day is down big, and then you'll see a couple of big up days, and everybody talks about whether the low's in for the year, and you see a lot of stats being posted about drawdowns and then there's, of course, we're entering the seasonally strongest period of the year with the market down, roughly 20%. So I think we've been down around the S&P's been down around 25%, and then it's like sort of hovering around being down 20% on the year in bear market territory. And there's also a lot of positioning and intraday volatility and reversals and that type of thing. So it's a dangerous market. It's certainly not a good swing trading environment at all. And it hasn't really been a good buy and hold environment. It's just been the whole year has just been a tough environment. And so with that said, we'll look at a couple different things. First thing I wanted to pull up was this chart that you may see from time to time. This is a J.P. Morgan chart that shows, and I always think that this is really interesting. I mean, every time you look at this chart, you think to yourself, well, on an annual basis, right? And what this is, I mean, it looks kind of weird, but these the bars on the top of the histogram show what the return was for any particular year. Going back to this goes from 1980 to this year. So this is this year right here. And this chart, might be a couple of weeks old or whatever. So I don't know if 25% was the exact max drawdown so far this year on the S&P. But anyway, what you're seeing here is that these bars on the top represent what the annual return was for the years, and then the bars on the bottom are negative years. You can see that the positive years outweigh the negative years significantly, right? And then these red numbers are the max drawdown for that year. So, for instance, back here in 20, well, I mean, it's hard to see exactly which years are which, but this looks like 2015. So the max drawdown would have been 12%. Like the market was down 12% at the lows for the year and ended down 1%. Right? And so here's this is 2018. This one I know for sure because I remember 2018 was a really weird year. Where my mouse pointer is, 2018 was a really weird year because, as you recall, it sold off into the end of the year pretty significantly. But the max drawdown that year was 20%, and then it only ended up down 6%, right? And if I'm not mistaken, the Fed was embarking on a rate hike cycle. The Fed was raising rates or something, and I don't remember if that was. There's been a couple of times where the Fed started to raise rates, and then basically lowered them, right? So anyway, so you can see that there's been lots of, well, here you go. Despite average intraday drops of 14%, which is if you averaged out all these red numbers, annual returns were positive in 32 of 42 years, right? And so you can see that there's a lot of years that had pretty significant drawdowns, and then the year, didn't really close anywhere near the max drawdown, right? And a lot of years, well, it makes sense. I mean, when you start the year, I mean, at some point you're going to have corrections and pullbacks and that type of thing. And so the average is 14%. This year's a little bit different because, because of a lot of things. I mean, here's what this chart doesn't show you is, and I see this a lot with statistics, is that a lot of financial professionals, the stock market has more statistics than baseball, right? And so you see all these different statistics, and I think I mentioned last time that one of the guys, one of the old timers on CNBC said the average bear market lasted 15 months, and he said the average bear market, and I don't know, if he was going back to the beginning of time or or what, because a lot of statistics don't incorporate the 70s, which was the last time that we had inflation running like it is now. And so, and then you see statistics going back to World War II, right? I saw something like that because, as you recall, a while back when we had the big rally, a few months back. Let me see when that, back here in June to the middle of August, they started throwing out this idea that when a bear market retraces 50% of the bear market move, that it never makes a new low, and that was based on stats going back to World War II. Well, guess what? Prior to World War II, like around the Depression area, there was roughly a 50% retracement in like 1932 or something like that. 31, 32, but maybe it was 1930. I don't know. But anyway, there was a bear market, and then the market retraced about half of, had a 50% rally and then did make a new low. And so that's what happened this time. So anyway, it's just kind of funny. You got to take all these stats with a grain of salt because, but, then again, we all know as, traders and investors that, that your typical year, and this got me thinking too, that when you get a huge, like if you get a big drawdown year and it closes, down near the lows or something like that, sure. I mean, you could get a 20-something% rally the following year, but that doesn't necessarily mean that, you're back, busting out new high after new high after new high. All it means is that, hey, like, back here in '08, the following year was up 23% after being down 38%. So that didn't necessarily. So anyway, there's old saying about lies, damn lies, and statistics. And so, market statistics can be, I won't say manipulated, but you can present market statistics to make just about any sort of case that you want for anything happening. So let's look at the weekly chart. Nowadays, in this type of market environment, the weekly chart to me is much more important than the daily chart. The daily chart's got tons and tons of noise on it, and with this kind of crazy volatility, there's I'm not going to draw this on here because I thought at the beginning, before I started the show, I thought, well, here's what I'm going to do. I'm going to draw this. Well, heck, maybe I will. Maybe I will draw it on here. Let's just see if I can do this, because drawing on these charts can be a little cumbersome, um, doing it live, but this is kind of interesting. So give me just a second here because get my there we go. So yeah, here's what I wanted to put on this chart is this fib, right? And you guys know over the years, I mean, y'all that have been around for many, many years listening to the show, we should do the show on Wednesday nights, right? Um, all right, what I wanted to get off of there, see, this is why it's kind of annoying to, okay, I don't want it filled. There we go. Anyway, long story short, basically from the pandemic low to the all-time high at the beginning of the year, um, it's always worthwhile to at least look at the fibs. I mean, people swear by these things and they use them on all different time frames and different things with them and that. But sometimes, bigger picture stuff is where I tend to at least want to be aware of the major fib numbers, right? I've seen or heard of people using them like on intraday time frames for, drawing different fibs and that, or even on different charts. But anyway, on a weekly chart, it's especially in an environment like this, it kind of at least makes sense to be aware of it. But what I found the most interesting was from the pandemic low to the all-time high in the history of the world, and then um, it basically retraced about 50% of that. I mean, it did retrace it. It retraced 50% and found some support there. And so that's kind of interesting. And you also notice that that 50% retracement kind of coincided with the highs of this little congestion area, shortly after, well, I don't say shortly after, but back in 2020, zoom out a little bit there so you can see that. So there's the pandemic crash, You could basically call it a crash. I mean, the S&P lost 35% from intraday high to intraday low in, you know, in 5 weeks. You could call it 5-6 weeks. So 35% in 5 or 6 weeks. um, For one thing, I think that there was so much going on with the pandemic at the time and the news and, lockdowns and all that crazy stuff that you recall. I don't think anybody had a chance to sell, right? Like this first big down week and then, this volatility, I think people were, yeah, I would say individual investors were more concerned about, what was happening, and there was a lot going on, obviously. And so I don't think anybody got an opportunity to sell. It was like deer in the headlights, right? And you turn around a few weeks later, the market's down, 30% or whatever. And so this is like right here at the lows, obviously, you remember the big turnaround was because the Fed slashed interest rates to zero and threw trillions of dollars into the system at the time, and the subsequent rally was based on that, and then also the result of that was also the inflationary period that we find ourselves in. So anyway, that's all history, but the interesting thing is that the market retraced 50% of that move and found support, right there around 3,500, which is, pretty close to the highs prior to the pandemic sell-off. Was kind of interesting, right? I mean, it's in the bigger scheme of things, it was pretty darn close, but it was sort of seemed like a sensible place for the market to find some support. 50% retracement, and so now the big question is this 61.8% retracement in play? So we don't know, right? Somebody's really bearish or whatever. They think that, the lows are not in for the year. And see, that's the other thing now is that I'm going to take this off of here. Now that we are like, getting, whoops, see, this is why I don't want to do that. All right, let me fix my chart real quick. Now that we're into, October and getting towards the end of the year here, everyone's sort of focused on, there we go, the end of the year. That's what this is what I wanted to get on the chart, is this 2023, because this vertical line right here, is the end of the year. And so, this is how many weeks is left in the year. And so, it's interesting because, everything's sort of based on, and so now I've made another mistake here because I wanted to draw the downward sloping trend line across those highs. Let me do that real quick. Yeah, trend line across the highs, extended out to the end of the year is what I wanted to look at. And also, doing this on the show on the screen right here, it kind of makes a little bit more sense to do this on a, to draw that trend line on a weekly chart, so you get a little bit better look at it. So, a couple things can happen here. Couple things can happen. One is, there we go. Well, yeah, I wanted to squeeze it up. So the thing to focus on is the end of the year line right here. So just I believe it was last week, or maybe it was a while back, and they just came on TV and reiterated it. But the main guy from Goldman Sachs lowered his year-end price target for, I don't know how many times they've lowered it this year, but anyway, Goldman Sachs year-end price target's now sitting at 3,600. S&P's at 3,700. So at the time, it was right around 3,600, and it was just kind of funny. I saw the guy on TV, and these year-end price targets are kind of silly, and they're kind of meaningless because they're subject to revision, for one thing, and all the prominent guys from the big investment firms, at the end of each year, they come out with the price target for the following year, and it's just kind of funny. And I mean, they're always not always, but typically in any given year, they're way, way off. And then throughout the year, depending on what the market does, they either raise or lower their year-end price target. And so it was funny. And I guess this is last week. It was just humorous to see the guy from Goldman Sachs, on CNBC, talking about their year-end price target had been adjusted to 3,600 right when the market's trading at 3,600 last week. So anyway, what I was getting at here was sort of what to expect for the end of the year, and that's a little tricky. That's a little tricky because you guys know that I always look for symmetry on the charts, and that's always sort of been my thing. Is looking at the charts, and obviously it's a game of odds, and anything can happen. Nobody can predict which way this thing goes. But the symmetry on this chart that I see anyway is from the high to the and again, that the one thing that I never hear anybody talk about this that I've been talking about for years is focusing on the sort of the white space, in between the bars, in between the price bars. And so, if you look at this initial sell-off and retracement to the main trend line here, look at that white space in between there and kind of, visualize sort of the cup. And then you have another sell-off, and you look at this area here and the retracement to the trend line. right? Which is kind of, there's I see some similarities, right? And like I say, if I had a way to shade that in, it would look you'd see it a little bit better. But anyway, you kind of sit back and close one eye or whatever. But look at the white space here and here. And so if the market, makes a third, well, I won't say, yeah, well, one, two, a third attempt at the trend line, that's the sort of, positive potential end of year rally where it tries to work its way up to this trend line. Now, obviously, we could get a huge rally that takes it up to the trend line, ahead of the end of the year. It could bounce around a little bit more here in this area. I mean, heck, there could be, you could think, like, look back here, last October, November, you kind of had that spike low and a few weeks up. Remember, we're still looking at the weekly chart. And then you had that, big drop that basically retested the lows. And so, there's potential for that too. There's a lot of crazy stuff going on out there in the world, and you got the elections coming up, and yeah, which brings up another interesting point. I heard or saw someone mention something about, or I should say I read, because anyway, I read that someone thought that they, air quotes, they were going to do everything they could to try and keep this market together into the midterm elections, right? Because it's been a rough year, and between the high inflation and, the other day there was somebody, a financial professional on the Today Show, which is, I'm going to guess that the Today Show is typically, their demographic is housewives, and so when you get a financial professional on the Today Show saying, they always come on and one of the first things they say is, think long term, and whatever you do, don't panic. I mean, and so that the market is rough when there's a financial professional on the Today Show telling people not to panic, right? That's always their the sort of I don't know. I find it humorous because over the years, every time that we've seen some sort of cataclysm in the market, bear market, that type of thing, that's what they come. They never tell you to panic. They never tell you to panic when the market starts pulling back from the highs. They always wait till stocks have been crushed, and then they tell you not to panic, right? But and they say dollar cost averaging over the long term, and in theory, 401k money is people have jobs with employer matches. 401k match is free money, and depending on the math, a lot of times, you can't lose, basically. If they're matching you 100%, if you put in $10 into an IRA or a 401k and they match you $10, then the market's got to go down 50% and you're still even because you've doubled your money every contribution. So anyways, I mean, all that makes sense, but us as individual swing traders, it's a different sort of ball game, right? I mean, that's kind of the angle. I don't really talk about, I definitely don't, give financial advice at all. There's no, there's no financial planning. There's none of that kind of stuff. I mean, the kind of, that's for, obviously, people should get their financial advice from professionals, right? And so, as what we've been doing for all these years is basically, just kind of analyzing the market, looking at individual stocks, swing trade setups, ways to trade, this and that kind of, and so basically my thoughts on the market, and obviously I have no idea at all what it's going to do. I don't know if the lows are in. And the funny thing is that so many people out there, and especially financial professionals, they form a thesis and then they're forced to stick to it, or they form a thesis and yeah, well, I mean, it runs the spectrum. I mean, not all of them are I don't know what the word I'm looking for, but a lot of them that they basically they sort of change their mind whichever way the wind blows, right? But they seem extremely adamant about whatever their thesis is at the time, and of course they have they have financial um, somebody that's managing someone else's money, right? Which is a lot of these people you see on TV, and the ones that you read about and this and that. I mean, they're managing other people's money, and so it's kind of like it's kind of like real estate agents have to always be positive on the real estate market no matter what's happened. I mean, you're not going to find a real estate agent that says, "Oh, geez, I wouldn't buy a house now," right? They never say that. And so it's like, it's like going to the barber and him telling you you don't need a haircut. So my point was these financial professionals, obviously they have a vested interest in people always, staying invested or buying more and this and that. And theoretically what I was talking about before, 401ks, IRAs, dollar cost averaging into the indexes. And so here's the other thing that kind of cracks me up is on CNBC in particular, this whole thing about recommending individual stocks, like like it's some kind of I mean, right? I've seen stats on there where 85% of active money managers underperform the index, right? And then the next, then the next thing they have some guest on that starts recommending a bunch of individual stocks to you. And so if you look through individual stocks this year, I mean, it's just absolute disaster. And so obviously indexing is, indexing is the way to go. I saw another stat recently that said that the 60-40 portfolio, right? Like 60% stocks, 40% bonds. See, bonds have just been decimated this year. A 60-40 portfolio, which is, the supposedly the conservative portfolio, is having the worst, year to date, the worst year to date in like 100 years or something crazy like that, because bonds have just been decimated. But I digress here. So my point with this particular chart was to show the possibility of, and I can't really draw it on here, but I mean I could, but the possibility that it consolidates in this area and gravitates towards this line going into the end of the year. That's all I'm saying. Like the symmetry, like if I drew a little U pattern here and a bigger U pattern here and then a bigger U pattern here, and it could be the first quarter next year or whatever, or it could swing straight up there, or or maybe it flounders around a little bit and then drops further, drops to that 60. I should have left the fib on here, because that 61.8 retracement would take you down to about 3250, which is there's some smart guys out there that are still pretty bearish based on the macro picture. And see, that's what's driving things. I mean, the Fed is in an aggressive interest rate hiking cycle. There's debate whether we're already in a recession, or I was one of the big investment firms came out and said something like there's 100% chance that we're going to be in a recession next year, right? And so if this is what going into a recession looks like, and they're talking like recession a few quarters out, then geez, who knows? But anyway, that 3250 is probably, if for some reason, if there's a black swan, like if something crazy happens, a nuke goes off, or China decides to go ahead and invade Taiwan, or just something really out of the blue happens, that would be sort of the next technical level on the downside. But The idea, if everything kind of coasts along sort of as normal, right? And which I don't know what normal is anymore, but seasonally strongest period of the year, all the investment firms and the institutions have an incentive to drive this market higher into the end of the year so they can get their bonuses and not have to and feel better. They that way they can tell their clients, well, the worst is over and it was kind of rough and that, but we're positive going forward. We're cautiously optimistic in that. So the financial industry itself, the investment industry, they have a vested interest in trying to drive this market, higher into the end of the year here. And so right now we're in the thick of earnings season too. I mean, well, I won't say the thick of it. We're at the sort of at the beginning of earnings season, and that's going to be interesting to watch too, right? It's going to be interesting to watch because, going back to what I was saying before, all the Wall Street professionals' investment thesis is centered around figuring out, what the S&P earnings are going to be and then assigning a multiple to that, right? Which goes hand in hand with, interest rates. And so I think I said a couple of weeks ago that if I had if I just had to go out on a limb and say, what the Fed was going to do from here, they're going to raise rates, probably 75 basis points in November. And then, 50 in December, I'm going to guess, unless things are really ugly. So I would say that the 75 is already, baked into November. And then December is, they like to call it data dependent. And so it's basically going to depend, to me, like they could always just pause right there, right? I think that they've left they've left it open to be able to pause in December, and that's right around the holidays and stuff like that. And so if the economy's falling apart and the market's below 3,500, it wouldn't surprise me. But my sort of base case scenario is that they would raise 75 in November, 50 or so, depending on the inflation numbers in December, and then wait and see, right? That would make the most sense because they will have done, you know, the speed at which the velocity, I would say, the percentage that interest rates have increased is sort of unprecedented, right? You have to go back to Volcker, and there's an old saying that Fed moves take 6 months to work their way through the system, and so it's going to be interesting to see. I mean, and another thing that drives me crazy is the idea that 3-4% interest rates or whatever can wreak so much havoc on the financial system. I mean, that just seems like we're living in a different world because, as you older guys know, interest rates used to be a lot higher and everything was fine. So that just shows you there's way too much debt and leverage in the system, which has been built up over 40 years of the bond market. Speaking of the bond market, right? This TLT, it's worth looking at. This is a popular gauge of investing in bonds, I guess you should say. So anyway, yeah, what you're seeing right here, and especially like this year, right? This is a weekly chart, but year to date, you're seeing that this is why bonds, that 60/40 portfolio is down the most for a year in a generation. So let's see, there's BND, Vanguard Total Bond Market ETF. I mean, this is just epic disaster. So, um, anyway, yeah, I mean, there's lots of other things we could talk about here. The Nasdaq, while the S&P, and I'm still in the weekly charts, but while the S&P is down roughly 20% now and was down 25%, the Nasdaq 100 or the Nasdaq itself, talking 30%, maybe even a little over 30% here at the lows, and so that's pretty rough. Um, there's a couple other things I wanted to look at. Oh, real quick, real quick. I should probably switch to daily chart to look at some of these individual stocks, but yeah, Apple. So goes Apple, so goes the market. And some of you guys that have been around for a while will know that that was something they used to say about IBM, back in the 70s, I think, or whatever. Maybe it was 60s, 70s. I don't know. I wasn't uh, I wasn't as in tune with the market back then, because in the 60s I was a child. But anyway, so goes Apple, so goes the market, and this is an incredible chart, right? Because okay, the beginning of the year, and we had a couple of dips, and in that rally almost back to the highs in April, which coincided. And look at that straight up move. I mean, that is just this move from big sell off here, and that March rally we had in the market. I don't know if it's the result of Apple making this move, or Apple made this move as a result of the market, rallying. But that's just incredible. That straight up rally that practically took it back to the highs, right? And then even more incredible is, after this huge sell off here, right? The next rally that took, I mean, for Apple, the market cap of this thing, for it to make those kind of swings right there, just sort of shows you that, well, I don't know what it shows you, but it just seems incredible to me that it can make these kind of swings. I mean, these are dramatic zigzag moves, in the most widely held and biggest market cap stock, I think, or definitely in the top few. Anyway, so we've had this. It's had this pretty dramatic sell down now, and it's sort of consolidating here. And so what I was talking about, the end of the year move. So let's see. There we go. Um, it's in a consolidation period right here, and basically the end of the year move that I was talking about, whether we can rally back up to that trend line, a lot of it's going to depend on I guess Apple's reaction to earnings, and or what this price does. So we got the big zigs and zags, right? So we had a big zig here, and we kind of had a zag that's retraced most of it and finding support here. And so if Apple decides to make a run back up if it decides to make a run back up towards 160, 170, or at least another one of these sort of V bottoms, then the market's got a good chance of running up to that trend line. If it consolidates here and starts to break down, then the opposite's going to happen, And so if this were to, from here, sort of sell down to these lows or past the lows, then that 61.8% fib retracement is going to sort of come into play. So and then you got Tesla and a bunch of other big cap stocks. I'm not going to go through them all, but you get the idea. And so these things have just had a big sell-off, right? Look at this. Since last October, Tesla was $400, and of course this is split adjusted because that is split, but there's your $400, there's your $200, and so it's basically from the all-time high here to where it was just recently, 50% haircut, right? Which is pretty astounding. Anyhow, the idea here, you look at this consolidation. You could get some bounces and zigzags and that type of thing in here. You could get some consolidation at lower levels. You could, anything could happen. But what my point is that if Tesla were to get another one of these, big sort of rallies into the end of the year, like say this thing starts rallying up and it's up here to 275, 300. That and my guess is, I mean, if the market itself is going to rally, like these big caps, obviously the big caps are going to participate, and or when money goes into index funds, the first place it goes is the mega caps, right? And so just a handful of mega caps really drives the indexes. Microsoft's coming off of the lows here, a 52-week low, and it has that little spike low that we saw in the indexes. And so if it consolidates and forms sort of a cup, which you can kind of visualize. The thing of it is that it's hard to time that. Like, I can visualize a cup, but that doesn't mean that we can't go for a long period of time, sort of consolidating, or, one step forward, two steps back. But my point here is that, Apple, Tesla, Microsoft, Amazon, all these stocks have been crushed from the highs, and they've just had like another big leg down, and that's obviously why we hit the lows of the year, at 3,500 here recently. And so if these things are setting up for a year-end rally, if they're setting up for a year-end rally, and if nothing comes out of the blue to derail that, and if people, institutions start front running the Santa Claus rally and front running, the idea that things may not be as bad as they seem, or the Fed's going to pause or whatever, then, back to what I was saying before, the S&P probably has a decent chance of making a run towards this trend line by the end of the year. And so that was kind of the whole point of that, is looking at those mega caps. And so, the market and everything else just had this big sort of down leg. That was that reversal day there. Holy cow. I mean, you talk about a bullish engulfing candle. That's typically the type of thing that you see at near-term bottoms. Obviously, that was a huge gap down. And the funny thing is that this was all wasn't this like Bank of England stuff? I mean, the Bank of England, or the UK in general, had some stuff going on I won't even get into, because you probably know about it. But anyway, this is basically a result of, that's what you call sort of a capitulation low, reversal, that type thing. I don't have the volume on here, but anyway, that doesn't mean we can't just drift back down and take it out, but that's definitely, I mean, until and unless the market breaks that low, you have to sort of look at that and say, okay, well, that could potentially be it for the year. So, I mean, I joke around and say, every uptick since the beginning of the year, CNBC asks their guests whether the low's in or not. And this time, that particular low has a pretty decent chance of being the low for the year, unless, something comes out of the blue. So it'll be interesting to see. And I looked through, I ran the system. I looked through a bunch of charts looking for trade setups. It's too early. It's just too early. There's too much volatility here on a day-to-day basis, right? On Friday, this was last Thursday. On Friday, right, you got the gap up, a little push. Everyone was expecting follow through, because they see a reversal bar like that, they're like, oh, the low's in and stuff, it's all, and they act like the market's just going to take off and go back to the highs from there. And then, boy, that's actually healthy price action. It retraced half of it, right back into there, and retraced it. And then, of course, Monday, this gap up's that's an extraordinary gap up right there. And so, yes, the volatility is just insane right here. And so, with that said, just about anything can happen. So, a little consolidation in this area. I'll tell you, I see a W pattern forming here, which is one of the best bottoming patterns you can see. but this thing needs the market's going to need to break over 3,800. So, it could rally up towards there and then fail. It could rally up towards there and consolidate. It could poke through it, but if you draw a horizontal line like right about 3,800, that's where like this the middle of the W pattern. So, I mean 3,800, and then the top of the W is like kind of up here around 3,900. But it'll be interesting to see what transpires from here. I still think it's a little early. A lot's going to depend on what happens during earnings season. So stay tuned. Join me back here next week, and we will dive into this a little bit further.